She was born in 1840 in a log house her father built with his own hands, using timber cut from land he earned through labor, not loans. She raised 7 children, buried 2 of them, survived 3 brutal winters, and built a life so self-sufficient that the word debt never once appeared in her personal ledger. She didn't use a bank, not because she was poor, not because she was uneducated, but because the system she lived inside didn't require one. By the time she died, that system had been dismantled piece by piece, replaced by something that looked like progress, but functioned like a trap. This is her story, and it's yours too, because what they replaced, they made sure you'd never remember it existed. The world she was born into, a life built without borrowed money. To understand what was taken, you first have to understand what existed, when a woman will call Margaret, because that was the most common given name for girls born in rural America in 1840, opened her eyes for the first time. She entered a world that operated on entirely different principles than the one we inhabit today. Not primitive principles, not chaotic ones, different ones. Ones that had been refined over 2 centuries of settlement, tested by famine and flood and the particular cruelty of frontier winters, and found against all odds to work. Her father was not a wealthy man by any measure the modern world would recognize. He owned approximately 80 acres of land in central Ohio, a state that had only been admitted to the Union 37 years earlier. He had a wooden plow, 2 oxen, a smokehouse, a root cellar, a well, and a reputation. That last item, his reputation, was, in the economic world of 1840, worth more than any of the others combined, because in the world Margaret was born into, reputation was currency. Literally, the formal monetary system of 1840 was, by our standards, a complicated mess. There were over 1/600 state chartered banks operating across the United States, each issuing their own paper notes. A 10 bill from the Bank of Ohio might be worth $9.50 the moment you carried it across the border into Indiana. Counterfeit notes circulated freely. The average rural American encountered formal bank currency rarely and trusted it even less. And yet the economy functioned. Farms produced, houses were built, communities thrived, goods moved from hand to hand, generation to generation. How? The answer is so simple it sounds like something a child would invent, and so sophisticated it took economists over a century to fully articulate. They traded what they had for what they needed, and they kept careful track of who owed whom. This was not primitive barter in the way your high school economics textbook described it. 2 people accidentally meeting in a field, one with a chicken and one with a hammer, hoping desperately that the other needed exactly what they had. That cartoon version of barter was invented by economists in the 19th century specifically to make the old systems look unsophisticated. Anthropologist David Graeber spent years documenting this in his landmark research, and his conclusion was blunt. There is no historical evidence that the barter economy described in economics textbooks ever existed as the dominant form of exchange in any known society. What existed instead was something far more elegant, credit, but not the kind that requires a bank. In Margaret's world, credit was personal. It lived in memory, in ledger books kept by local storekeepers, in handshake agreements witnessed by neighbors, in the careful, unwritten accounting that communities maintained among themselves. Her father might plant his neighbor's east field in exchange for help raising a new barn in September. The debt wouldn't be paid that same day. It might sit open for 3 years, slowly balanced by a cord of firewood here, a side of smoked pork there, a week of labor during harvest season. The settlement wasn't always immediate, wasn't always equal in the moment, but it was always eventually honored, because the alternative was social ruin in a community where your neighbors were also your doctor, your midwife, your emergency food supply, and your only protection against a hard winter. The country store was the hub of this system in a way that's almost impossible to fully convey to someone raised in the age of Amazon and credit scores. The storekeeper, usually the most literate person in a rural community, kept a ledger for every family in his territory. He tracked what they bought, what they brought into trade, what they owed, what was owed to them. Eggs could cancel out calico fabric. A bushel of dried beans could offset a bottle of medicine. The storekeeper was simultaneously a banker, an accountant, a commodity broker, and a community mediator, and he performed all 4 functions without charging interest, without requiring collateral, and without reporting to any federal authority whatsoever. Historian Lawrence Friedman, writing about the legal structure of 19th century rural commerce, described it this way: the local credit system was self-regulating in ways that formal banking structures have never successfully replicated. Its enforcement mechanism was not law, it was community. Margaret's mother was as essential to this economic system as her father was. The domestic economy of a mid-19th century farm was not a support system for the real economy. It was half of the real economy, and in many seasons, the more stable half. The butter Margaret's mother churned, the cloth she wove on the loom in the corner of the main room, the preserved vegetables and fruits that filled the root cellar by October, these were not hobbies or domestic niceties. They were production. They entered the credit ledger at the country store with the same weight as her father's grain and timber. A woman in 1840 who was skilled with a loom, competent at cheese making, and known for producing superior quality butter occupied an economic position that is genuinely difficult to translate into modern terms. She was a manufacturer. She was a supplier. She had leverage. When the storekeeper needed goods for his shelves, he came to her. The quality of her production determined her family's access to goods they couldn't produce themselves: salt, iron, tools, medicines, fabric they couldn't weave. This matters. It matters enormously, because what was dismantled in the decades after 1860 was not just a financial system. It was a system of production that gave ordinary women genuine economic power, rooted not in wages someone else controlled, but in skills and output that the community directly valued. Margaret learned these skills the way all knowledge transferred in her world, through a form of apprenticeship so embedded in daily life it didn't have a name. She stood beside her mother at the loom at age 6. She was managing the butter production largely on her own by age 11. By 14, she understood the full cycle of textile production from raw fiber to finished cloth. She didn't learn this in a classroom. She learned it because the knowledge was survival, and survival was the curriculum. The apprenticeship system that governed skilled trades in 1840 was more formalized than Margaret's domestic education, but it operated on the same principle, knowledge transferred through relationship, not institution. A young man apprenticed to a blacksmith in 1840 would spend 7 years learning not just the physical techniques of the trade, but the pricing structures, the community obligations, the standards of quality that governed his craft. When he finished, he was not an employee. He was a craftsman. He owned his tools. He set his own prices within the guidelines established by his trade. He answered to his community, not to a corporate employer. The guild structures that govern these trades in American cities and the informal equivalents that existed in rural areas were not perfect systems. They were sometimes exclusionary, sometimes resistant to innovation, sometimes more interested in protecting the status of existing members than in serving the broader community. History should not be romanticized, but they provided something that the system which replaced them deliberately did not afford: a guaranteed minimum standard of living for anyone who completed their apprenticeship and maintained their reputation. A safety net woven from mutual obligation rather than government bureaucracy or corporate charity. In 1840, Margaret's world had no Social Security Administration, no federal unemployment insurance, no Medicare, no Medicaid. It also had no need for them, not because poverty didn't exist, but because the community structures that existed performed those functions informally, imperfectly, but continuously. When a family's barn burned, the neighbors showed up, not because they were legally required to, because the family whose barn burned would show up when the next neighbor's barn burned. The system was self-reinforcing. The cost of opting out was too high. By the time Margaret turned 21 in 1861, that world was about to change in ways she could not have imagined. The same year she came of age, the first shots were fired at Fort Sumter, and within 2 years, the financial architecture of the country she had grown up in would be dismantled and replaced by something new, something that needed her to borrow money, something that needed her to need a bank. The question no one asks is, what exactly did the new system replace? And why did it have to happen so fast? We'll get to that. But first you need to understand how completely self-sufficient her world actually was, because only then will you understand what the destruction of it actually cost. The systems that made debt unnecessary. There is a ledger book sitting in the archives of the Shelburne Museum in Vermont. It belonged to a country storekeeper named Asa Knight, who operated his store in Dummerston, Vermont from 1821 to 1842. The ledger is enormous, nearly 1,000 pages, and it records every transaction that passed through his store during those 2 decades. Historians who have studied it in detail describe it as one of the most complete pictures of a functioning pre-bank rural economy that exists anywhere in America. And what it reveals is not the chaotic, inefficient system that economic textbooks describe when they explain why centralized banking was necessary. What it reveals is a system of extraordinary sophistication, running on social trust and community memory, handling thousands of transactions annually without a single dollar of bank-issued currency changing hands in the majority of them. The entries read like poetry, in a way. Butter credited against calico fabric, a day's labor offset against a bag of coffee, salt pork balanced against boot leather. The currency of the system wasn't printed on paper by a bank. It was produced by human hands in kitchens and barns and workshops, and its value was determined not by a financial institution, but by the community that used it daily. Margaret would have known systems like Asa Knight's store intimately. The country store was not a convenience in her world. It was infrastructure. It served the function that we now distribute among a dozen separate institutions: the bank, the insurance company, the commodity exchange, the social services office, the community center, all of it consolidated in one building, run by one person who knew every family for 20 miles in any direction. But the country store was only one layer of the system. To understand the full architecture of the world Margaret lived in, you have to understand the 3 interlocking structures that made banks unnecessary: the domestic production economy, the skilled trades network, and the mutual aid system. The domestic production economy has already been introduced, but its full scale deserves emphasis. A study of probate records from rural Ohio in the 1840s, the exact region where our Margaret likely lived, shows that the average farm household produced the following annually for trade or community exchange: between 200 and 400 pounds of butter, between 50 and 150 yards of woven cloth, substantial quantities of preserved vegetables, fruits and meats, candles, soap, medicinal preparations made from locally gathered herbs, and in households with specialized skills, items like woven baskets, pottery, wooden implements, or leather goods. This was not subsistence production. This was surplus production, deliberately managed to generate the credits needed to access goods the household could not produce itself. The women who managed this production were operating as small-scale manufacturers within a distributed production network that covered the entire country. When historians estimate the value of 19th century domestic production and include it in calculations of national economic output, the numbers are staggering. Economists Rona S. Weiss and others who have attempted this calculation suggest that domestic production may have accounted for between 40 and 60% of actual economic activity in mid-19th century America, activity that was entirely invisible to formal financial systems because it never touched a bank. This invisibility would later be used as evidence that the system was primitive. In reality, it was evidence that the system was independent. The skilled trades network operated on similar principles at a larger scale. The craftsmen who built Margaret's world, the carpenters, blacksmiths, coopers, tanners, shoemakers, weavers, millers, operated within trade networks that governed pricing, quality, and the terms of exchange with a degree of sophistication that would impress a modern economist. The guild structures in urban areas were formal and documented. In rural areas, the equivalent structures were informal, but equally binding. A blacksmith in 1840 Ohio didn't simply charge whatever the traffic would bear for a new set of horseshoes. His prices were governed by what the community considered fair, a standard maintained not by law but by reputation and competition from other smiths who held to the same community standards. If he charged too much, the community knew. Word traveled through the same informal network that tracked every other social debt. The cost of overcharging wasn't a lawsuit. It was the slow withdrawal of community business, a punishment far more immediately devastating than any legal penalty. This system of community-enforced pricing is what made the Carpenters' Company rule book so significant and so threatening. The Philadelphia carpenters had simply formalized in writing what rural tradespeople enforced through social pressure: standardized fair pricing, transparent cost structures, a documented system ensuring that neither the craftsman nor the client could be exploited. The rule book was dangerous not because it contained trade secrets in the commercial sense, but because it contained proof that self-regulating economic systems worked, that communities could govern themselves economically without external financial institutions. Thomas Jefferson understood this, which is precisely why he wanted to read it. The third layer of the system, mutual aid, was perhaps the most powerful and the least understood. Mutual aid in Margaret's world wasn't charity. The distinction is critical. Charity flows downward from the fortunate to the unfortunate, and it carries with it an implicit imbalance of power. Mutual aid flows laterally among equals, and it carries with it an implicit promise of reciprocity. The barn raising is the most famous example, but it was only one expression of a pervasive principle. When Margaret's family faced a medical crisis, and in 1840, medical crises were frequent, expensive, and potentially catastrophic, the response came from the community before it came from any personal savings. Neighbors arrived with food to free up the household's labor. The local healer, usually a woman with an inherited knowledge of medicinal plants and practical medicine, provided care without presenting a bill, because the understanding was that her services would be remembered and reciprocated in some form over time. If the crisis required purchased medicines or the services of a trained physician, neighbors contributed what they could toward the cost, with the understanding that when their crisis came, and it would come, the same community would respond. This was insurance, not as a product, not as a financial instrument designed to generate profit for a distant institution, but as a social compact maintained by the daily texture of community life. Its premium was participation. Its dividend was security. The fraternal organizations that proliferated in the mid-19th century, the Odd Fellows, the Masons, the various benevolent societies organized along ethnic and religious lines, were formal institutional expressions of mutual aid principles that had operated informally for generations. By 1840, the Independent Order of Odd Fellows alone had tens of thousands of members across America, each paying small regular dues into a collective fund that provided sick benefits, death benefits, and support for widows and orphans. This was private, community-based social insurance operating decades before any government attempted to provide similar services, and doing so without extracting profit. Margaret lived inside all three of these systems simultaneously. She was a producer in the domestic economy, a participant in the trade network through her family's interactions with local craftsmen and the country store, and a member of the mutual aid web that her community maintained through church, neighborhood, and the informal daily obligations of rural life. She didn't think of it as a system. She thought of it as life. But it was a system, a remarkably functional, remarkably resilient system that had sustained American communities for over 2 centuries, and in the 2 decades following her 21st birthday, every layer of it would be deliberately, systematically dismantled, not because it failed, not because it stopped working, but because it was in the way. In the way of what exactly? That question has an answer. It has specific names and specific dates attached to it. And when you see those dates arranged in sequence, the word coincidence becomes very difficult to apply. The dismantling didn't happen all at once. It happened in stages, each stage carefully constructed to make the next one feel inevitable. It started with a war, the decade that destroyed a world, 1861, 1871's in 10 years that changed everything. April 12, 1861, the first shots at Fort Sumter. Margaret was 21 years old. If she was like most women of her generation in rural Ohio, she had probably never been more than 50 miles from where she was born. Her world was immediate, local, and deeply connected, not in spite of its smallness, but because of it. The web of obligations and relationships that made her economic world function required proximity, required knowing people, required being known. Within 10 years of that first cannon shot, every structural support of that world would be removed, replaced, or made illegal. The sequence of what happened between 1861 and 1871 is not taught as a unified story. It's taught as a series of separate events, each with its own noble justification: the Civil War, the National Currency Act, the Homestead Act, the Reconstruction Amendments, the completion of the Transcontinental Railroad, the expansion of the industrial labor market, separate chapters and separate textbooks. But when you place them on a single timeline, a different picture emerges. February 25, 1863, Abraham Lincoln signs the National Currency Act, passed by the Senate with a margin of only 2 votes, 23 to 21. The act creates the office of the Comptroller of the Currency and establishes a new system of nationally chartered banks. These national banks are required to purchase U.S. Treasury bonds and deposit them with the Comptroller, receiving in return standardized national bank notes they can circulate as currency. The official justification is stability. The chaos of sen and zaljad plus competing state banknotes must be replaced by a uniform national currency. The argument is compelling and to a degree accurate. The pre-war currency situation was genuinely chaotic, but the primary stated purpose, confirmed in the Federal Reserve's own historical archives, was not monetary stability. It was war financing. National banks were required to hold treasury bonds, creating a guaranteed market for government debt. More currency required more bonds. The system was designed from its foundation to make the federal government's debt instruments central to the functioning of American money. 1 year later, in 1864, a 2% tax was imposed on state bank notes. In 1865, that tax was raised to 10%. These taxes did not simply discourage state currencies. They eliminated them. By 1866, the number of state chartered banks had collapsed dramatically. The financial diversity that had characterized American currency for over a century was gone, replaced by a single centralized system in which money itself now required a relationship with a federally chartered institution. Margaret's family had never needed a bank before 1863. After 1865, their access to the currency of daily commerce increasingly depended on one, but the National Currency Act was only one element of the transformation. 9 months before Lincoln signed it, on May 20, 1862, he had signed the Homestead Act, the celebrated act that offered 160 acres of public land to any adult citizen willing to settle and improve it for 5 years. Free land, the democratic promise, the opportunity that generations of immigrants had crossed oceans dreaming of. The reality was something more complicated. The National Archive states plainly that historians estimate homesteading actually cost between $1,000 and $2,500 when tools, seed, livestock, and building materials are factored in, at a time when an average laborer earned between $1 and $2 per day, without existing community networks, without the established credit relationships of a settled rural community. A family attempting to homestead was almost entirely dependent on borrowed money to make the free land productive. The Homestead Act created the demand. The National Banking Act, signed 9 months later, created the supply. And the thing being supplied was debt. This is not a conspiracy theory. It is a sequence of events with documented outcomes. Approximately 40% of homestead claims were successfully completed. The majority of land claimed under the Act ended up in the hands of speculators, railroad companies, and large agricultural interests, precisely the entities with access to capital that individual settlers lacked. The promised democratization of land ownership produced instead a new class of agricultural debt. Meanwhile, something was happening to the skilled trades that formed the second layer of Margaret's economic world. The Civil War created an industrial demand that the existing craft network was not designed to satisfy. The Union Army needed uniforms by the hundreds of thousands, rifles by the millions, boots, blankets, tents, wagons, artillery, and the countless other material requirements of industrialized warfare. The craft system, which produced high-quality goods in small quantities through skilled individual labor, could not meet these demands. Factory production could, and in meeting the demands of the war, the factory system established itself as the dominant mode of production in the American economy. This shift was not simply technological. It was a transformation in the nature of work itself. The craftsman of 1840 owned his tools, controlled the pace and process of his production, set his prices within community standards, and answered to his trade and his neighbors. The factory worker of 1870 owned nothing except his labor, which he sold by the hour to an employer who owned the tools, controlled the process, set the wages, and answered to shareholders in distant cities. The craftsman was an economic agent. The factory worker was an economic input. For Margaret, this transformation played out in the textile economy, where she had always held real productive power. The domestic textile production that had formed a substantial part of her family's credit base at the country store was devastated by the expansion of industrial textile production. Mill-produced cloth, available at prices that reflected industrial efficiency, undercut hand-woven production with brutal speed. The loom in the corner of her main room, which had represented genuine economic leverage for her mother's generation, became increasingly obsolete in the late 1860s. Not because the cloth it produced was inferior, in most cases it was superior, but because the market no longer valued the quality difference enough to pay the price difference. The domestic production economy that had made ordinary women genuine economic participants was being hollowed out from beneath their feet. And then came 1870. The census of 1870 was the first to record every American by name, including formerly enslaved people who had not appeared in previous censuses. It was a monumental undertaking, and an enormously significant one for reasons that go beyond its historical importance. Because the 1870 census marks the moment when the American individual became, for the first time, fully visible to the federal government, named, documented, located, categorized, counted. Before 1870, if you wanted to trace an American family more than a generation back, you entered a landscape of fragmentary records, church registries, county deed books, estate inventories, the memories of living people. The government's documentation of your existence was incomplete. After 1870, the record becomes continuous, comprehensive, and centralized. Genealogists call it the 1870 brick wall, the point at which most American family trees become significantly harder to trace backward. What exists before that wall is a world of community record keeping, local memory, and informal documentation. What exists after it is a world of federal documentation, standardized records, and centralized data. The same decade that standardized money also standardized identity. And in that same decade, the mutual aid systems that had provided community insurance without institutional intermediaries were being methodically replaced by company towns that offered housing, food, medical care, and social infrastructure, all controlled by a single employer, all paid for with company script that couldn't be spent anywhere else. Margaret's world was not dismantled violently. It was dismantled by substitution. Everything the community had provided for itself, credit, production, insurance, identity, was replaced by an institutional equivalent that looked similar but functioned differently. The new system required her to be a customer where she had once been a producer, required her to be a borrower where she had once been a creditor, required her to be documented where she had once been known. The question that sits at the center of all of this is not whether the old system was perfect. It was not. The question is whether the replacement was inevitable or whether someone needed it to happen. The ones who refused. What happened to the communities that said no? Not everyone surrendered. This is the part of the story that the official historical narrative handles with a curious mixture of condescension and discomfort. The communities that refuse to participate in the new financial architecture are typically described in one of two ways as admirable anachronisms, charming holdovers from a simpler time, quaint and photogenic but ultimately irrelevant, or as dangerously regressive obstacles to progress, resistant to the improvements that industrialization and centralized finance were delivering to everyone else. Neither characterization is honest, and the evidence that contradicts both narratives has been sitting in plain sight for over 150 years. The Amish communities of Pennsylvania, Ohio, and Indiana occupy a unique position in American historical memory. They are simultaneously the most visible and the most misunderstood example of what economic self-sufficiency actually looks like when it functions across generations. Most Americans know the surface facts, the plain dress, the rejection of modern technology, the horse-drawn transportation. What most Americans don't know is the economic architecture that underlies the visible cultural practices and what that architecture has survived, the Amish economy of the 19th century, and to a substantial degree still today, operated on the same three-layer system that Margaret's world had used: domestic production, skilled trades networks, and mutual aid. The domestic production economy in Amish communities was not a lifestyle choice. It was a deliberate economic structure, maintained and defended because it worked. High-quality agricultural production, skilled craft production, surplus managed through community exchange rather than market speculation. The same principles that had sustained American rural communities for 2 centuries, preserved intact while the surrounding culture dismantled them. The mutual aid system in Amish communities, what they call Gelassenheit, or yielding to community, was and is not simply cultural. It is functional insurance, functioning risk management, functioning social safety net, all maintained without institutional intermediaries. When an Amish farmer's barn burns today, the community responds within days, not because of organizational directives, but because the obligation is so deeply embedded in community identity that it requires no enforcement mechanism. The same principle that made Margaret's community resilient in 1840 makes Amish communities resilient today. But the Amish are not merely survivors. They are evidence that the systems being replaced in the 1860s were not primitive or insufficient, but functional and sustainable. Evidence that the replacement was a choice, not an inevitability. And the federal government's response to their continued existence reveals something important about how the new system understood its relationship to the old one. The Social Security Act of 1935 required all Americans to participate in a mandatory federal insurance program funded by payroll taxes. For most Americans, this was unremarkable, a new institution performing a function that most people no longer had community structures to perform. For Amish communities, it was a direct confrontation between two competing systems of mutual insurance. The Amish objection was not primarily financial, though the financial implications were significant. It was theological and communal. Their faith explicitly prohibits the acceptance of commercial insurance, which they view as a failure of trust in God and community. Social Security, as they understood it, was commercial insurance administered by the government. Accepting it would undermine the mutual aid system that was both their religious practice and their economic foundation. And paying into it, even without receiving benefits, would require them to formally subordinate their community insurance system to the federal one. They refused, and the federal government spent 3 decades trying to make them comply. The IRS pursued Amish farmers for unpaid Social Security taxes through the 1950s and into the early 1960s. In some documented cases, horses and farm equipment were seized as payment for unpaid taxes. The image of federal agents seizing a farmer's horses to collect Social Security taxes he had refused on religious grounds generated the kind of publicity the government preferred to avoid. Congress eventually intervened, passing legislation in 1965 that granted Amish communities an exemption from Social Security taxes, provided they filed IRS Form 4E29, application for exemption from Social Security and Medicare taxes, and formally waived any future claim to benefits. They still pay income taxes. They still pay property taxes. They contribute to the public revenue in every other way. They simply refuse to participate in the mandatory mutual insurance system because they already have one and it works. The legal framework required to maintain this exemption tells you something important. The Amish don't simply opt out of Social Security the way you might decline a gym membership. They must formally apply for exemption, be certified as members of a recognized religious group with established mutual aid practices, and file ongoing documentation of their continued participation in their community insurance system. The exemption is not a right. It is a permission granted by the federal government, reviewed and potentially revoked. To maintain a system that functioned without incident for over 150 years, they must ask the government for annual permission. The implications of this are significant. The system that replaced community mutual aid did not simply offer an alternative. It made the alternative require special legal status to maintain. The default for every American without a specific religious exemption is mandatory participation in the institutional replacement. Opting out is not a choice. It is a legal exception granted to a very small number of people for very specific reasons. The Amish were not the only communities that resisted. The fraternal mutual aid societies that had proliferated throughout the 19th century, the Odd Fellows, the various ethnic benevolent societies, the women's mutual aid organizations, faced a different kind of pressure, not legal prohibition, but economic suffocation, as the industrial wage economy made the small regular dues that funded these societies increasingly burdensome for working class families, and as the expansion of commercial insurance products offered institutional alternatives that required no community participation, only monthly premiums. By the 1920s, the fraternal mutual aid movement that had provided private social insurance to millions of Americans was in steep decline. By the 1940s, with Social Security established and commercial insurance normalized, it had effectively ceased to function as a significant economic force. Not because it had failed, because the economic conditions that had made it necessary and possible had been systematically altered. The women's economic networks that had given Margaret her productive power were similarly dismantled by transformation rather than prohibition. As factory production replaced domestic production, the economic value of traditional women's skills declined, not because the skills themselves became less effective, but because the market structures that had rewarded them were replaced by market structures that rewarded industrial output instead. The butter and cloth and preserved foods that had given a skilled farm woman genuine economic leverage at the country store became commodities, produced in factories at prices that individual household production couldn't match. The replacement of women's productive economic power with women's wage labor in factories was presented as liberation. And in some genuine ways it was. Factory wages gave women income independent of a husband's decisions, access to goods independent of domestic production, and social connections independent of family and community structure. These were real gains, but they came at a cost that is rarely examined: the loss of the economic power that had come from production, replaced by the much more precarious economic position of wage dependency, the same vulnerability that made the factory worker dependent on his employer's decisions about wages and hours made the factory woman dependent on the same decisions. The craftsman who owned his tools could walk away from a bad employer. The factory worker who owned nothing but her labor could not. And while these transformations were occurring in the economic structure of daily life, something was happening to the records, something that deserves its own examination, because in the same decade that the economic architecture of Margaret's world was being replaced, the documentary record of the world that had existed before it was becoming incomplete in ways that were both convenient and, in some cases, difficult to explain as accidental. The 1890 census was supposed to be the bridge, the record that connected the old world to the new one, documented in full for the first time. It would have contained the names of everyone who had lived through the transition, everyone who remembered what had been replaced. It was destroyed.